Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
My good friend, Dr. Ike Reichert, who is a pastor and just an exceptional human being, he's told me over a very long period of time, I can't even tell you how many times, it's a lot easier to tell your life story than it is to live it. I think we're all probably in one of those moments right now where someday we'll look back on this event called coronavirus and we'll share our story, how we participated in it, what happened to us during that period of time, how it made us feel. And hopefully we'll all get to share a story of recovery and restoration. Hopefully that'll be your individual story in your personal lives and as well in your professional lives. And in fact, much to the surprise of some, there's actually people still out contracting real estate right now and closing on real estate. So maybe not as many as we had hoped for when we started the year. We'll get to that in a few minutes, but there certainly is still activity. We experienced last week a pretty robust amount of activity in terms of new inquiries for credit pulls, et cetera, et cetera. I think much of that is because maybe we're getting to that point where it's kind of like in the middle of the night when it gets really, really dark. The one thing you know is that there's light coming. So it feels a little bit like we might be getting into that moment right now where March 16th, when the lights were officially shut off in America, for all intents and purposes, we've never had an experience like that related to the economy. But then again, in my lifetime, we've never had anything quite like coronavirus. But we did shut the lights off intentionally for all intents and purposes back in the middle of March. And we were all told to go home, to quarantine. There were businesses that were defined as essential and then some not essential. I never really liked that idea that somebody's job could be deemed not essential. I don't care what they do for a living. If you ask any person that's employed in America, do you think your job is essential? You better believe it. Why? Because they get paid as a result of going to that job. But of course, the words we use during crisis like this aren't intended to, I don't believe, to hurt anyone. They just wind up feeling a little strange. But in either event, our industry was deemed to be essential. And so we were left in a position, and all of us were concerned about that. If you can remember, God knows it feels like it's forever ago, but during that week and the following week, we were really trying to get clarity as to were we going to be essential? And then past that, how would we all adapt to operating during this whole process? And so we decided that News You Can Use would be a forum, a really thoughtful forum to share information with you, to keep you up to speed as real estate professionals, and for that matter, whoever else is out there with us watching, certainly Supreme Southeasterners and friends and family members. But we just really wanted to give you our message. And so I first thought about the term of recovery. And because we were in the month and still are in the month of April, when Easter and Passover, it really kind of led me to this idea of restoration, which is very similar, of course, in terms of its meaning as recovery. And any restoration that takes place in a personal relationship, brother, starts with love, where you really care about something enough. Then you'll make sacrifice because you love. And then finally, if you're in any relationship, and all of you that are at home with your spouses, significant others, if you don't get this third word right, you will not be in long-term relationships over a long period of time in your life. For that matter, even with your customers, and that is forgiveness, because of course we have to look past sometimes the imperfections that we all have. And then finally, there's hope that tomorrow can even be better. And I think about that right now. I think about the love all of us have for our way of life, the sacrifices that we all make for the people in our life and for the work that we do when we go and do it in real estate and finance. I mean, oftentimes it requires sacrifice of our time and of our talent. And certainly we earn treasure in doing it. The forgiveness part, look, you know, we work every single day with a number of different partners. We work with different people, customers, and we have to accept, maybe not forgive, just accept the fact that people don't always do exactly what they are supposed to do when they're supposed to do it. But and then we finally get to hope. So I just want to encourage all of you today, because I'm in a very hopeful spirit right now. I am. I think we've gone through an awful lot. I don't believe in any way that we're out or even close to that, but I think we're certainly not just in the beginning of the night. We're getting closer to the darkest part of the night. Just like the corona itself, I think the economy, as we told you last week, was going to get some news, and that news, just like several weeks ago on corona, when they said we're going to go through the worst couple of weeks, I think we're doing that right now with the economic data. So let's talk again now about the road to recovery, and let's just check in terms of what we thought needed to happen and what has happened, and then we can talk about what's next. As we talked about the data deluge, it's beginning now. Last week we had retail sales down 8%. That's an unprecedented number. We've never seen one like that in the history of our U.S. economy. We also have other news generally in the economy, whether it's in terms of the unemployment filings that were pretty substantial. Last week we had an additional 6 million plus jobs and that had come down a bit from the previous week. So we now are up to 22 million in terms of job losses that have taken place. So what work is being done in terms of where we go next? And that's what all of us want to know. So let's do that. Let's go to the next slide if we can. What to watch? We've said from the beginning that there were really three things to keep our eye on. First was monetary policy, second was fiscal policy, and the third was corona itself. So the Fed, as I've told you over and over again, they benefited greatly by having the previous Fed go through the Great Recession, where they had to get out their playbook, that is the Federal Reserve, and execute a number of different policies during the Great Recession that they had never issued before and managed before. And this time around, this Fed was earlier to enact policy and a lot more aggressive. They've done just about everything you could possibly ask them to do. And really their focus, and I've told you this, but I'll repeat it again, their focus is they have two mandates, the Federal Reserve does. One mandate is full employment in America. The other one is to keep inflation below 2%. Those two things keep in balance with each other. And when they're getting it right, and they were getting it right, the economy is at its best. To make the point about how good the Fed has been, this is Fed Chair Bullard, not the chair, excuse me, Governor Bullard, and he made the comment this week that he's given thought to potentially the Federal Reserve, this is, paying some of the companies that are working on vaccine and on remedies for this disease so that they can increase the velocity by which they would manufacture. So I just thought it was fascinating when I read the story that you have the Federal Reserve, which is in charge of monetary policy in our country, that's actually considering writing checks to companies so they can hurry up the process and get a vaccine and hurry up the process to get to a remedy or a cure actually for this. So we mentioned a few minutes ago that 22 million Americans have filed for unemployment benefits in the last 4 weeks. To put that in context, there were 22 million jobs created in the last 10 years in what has been the best recovery, or excuse me, not the best recovery, the longest expansion that we've ever had in our nation. So we had a 130-month expansion, almost 11 years. It ended in March of this year. And during that period of time, that 11-year period of time, we increased employment in America by 22 million. We've given up all of that now in a 4-week period of time. Talk about needing to flatten the curve. We need to flatten the curve on unemployment filings, but we'll get to that here in a second. And the third thing, so we talked about Fed and monetary policy, and then Washington, and all of you have probably read in the last day or two, there is additional money being asked for right now by the president so that we can add to the stimulus bill that was already put out for the payment protection program for small employers, which the good news is it got completely filled up. $400 billion was used immediately. So apparently we struck a chord with the right people who were in need. And now they've asked for another $400 billion. So that would take the work that Washington did in fiscal policy to 2.5 trillion. And again, just context, 2.5 trillion is more than half of our annual economy. So they are doing everything they can to really, jumpstart, if you will, the economy. But nothing's going to happen until we solve Corona itself or get a hold of Corona. So flattening the curve, you all have heard this over and over again. The point of flattening it was to slow it so that we wouldn't overrun our hospitals. Obviously, we were behind in some areas, notably New York. But we're getting closer to this concept of getting it flattened out. And again, that does not eliminate COVID-19. All it does is slow its spread. And then we've got, a window of opportunity to think about how we can otherwise give more time to those that are working on vaccines and working on medical treatments that could potentially keep it from being what it is today, which is in some cases, not all cases, obviously, a killer. So that's what the work is. But as I now talk about flattening the curve, we're going to add something to the conversation. If you look at the graph on the left-hand side, this is the coronavirus cases in the United States. And so, we talked about flattening the curve starting in March, and obviously it took some time to get that done. But we're at that point now where we are seeing additional cases, but we certainly have flattened out, and notably in hospitalizations, and notably we're flattening and slowing in deaths. If you look on the right-hand side, kind of following together with the flattening the curve concept, and we need to do this is, and I guess last week we actually did it. So it was better last week, the unemployment claims, but we needed to flatten the curve. If you look prior in January and February and March, you could see unemployment claims pretty regular in the country. Somebody loses their job for any number of reasons. They file claims. Those claims were kind of flat. We were in the best employment market in the history of our country just 6 weeks ago. 6 weeks ago, we were in the best employment ever in America. And then you see those notable changes in the graph. And that's why I believe we need to flatten the curve now on the economy in terms of unemployment claims, because those are just, they're amazing. So the coronavirus cases up are now around 800,000 as we think about being in April. The unemployment numbers, obviously a lot bigger. We're talking about in cumulative now 22 million, but we got up as high as just under 7 million in a week. So certainly we want to see those types of numbers come in. And by the way, if you've been listening to the news and hearing conversation about we got to get America back open again, the graph tells you on the right why we got to get America back open again, because we now have 22 million people unemployed that were not unemployed if you go back just 6 weeks ago. And we certainly cannot continue with that trend. There's not enough money. We could keep printing money. But the other issue is, and we all started seeing it over the weekend in the last week, and I think it's going to grow. I don't think people like staying home as much as, well, I don't think they like staying home at all. We're starting to see a bit of break from what's taking place. So really the economy we left 6 weeks ago was the longest expansion, 130 months. It ended in March. And then 25 million jobs during that period of time, as I mentioned. We've given most of them back here now in the last 30 days. The Dow went from 29,000 to essentially roughly right around 23 today. And the GDP estimates growth for the economy are at -40 now for the second quarter. There have been some movements recently to kind of at least have a conversation about what does it look like to open America back up again, turn the lights back on, get from the darkest hours in the late evening to the light again. That's what we're all working on. And so there's some phasing that has been proposed by Washington to give the states some direction as to exactly how they should think about what they should think about. And that is that there should be a downward trajectory of the illnesses that are reported, and a downward trajectory of the cases reported, and then of everything to do with it, hospitalizations, and of course, all of those things would get us in a position where we would feel like, okay, now the conditions exist. And that's really what Washington has done, is create conditions by which governors should start thinking about moving forward. And then it's going to be up to each governor. And what it appears like now, it's not only going to be up to the governor, it's going to be up to some of the people that live in these states. People certainly want to go back to work. They want to go back to their way of life and what's normal. I'm not sure all of those things are going to happen right away. And in fact, I know they're not in every state, but I do think the pressure from the bottom up is now starting to increase. So governors are going to have to answer up for what they're doing and why they're doing it. And, you know, I'm not an advocate that we just turn the lights back on and go back to work, because I think that would give up a lot of the ground that we've already taken back in terms of this virus. I certainly think, however, that we got to get America back to work. Some way we've got to start taking steps. And I will tell you this, that indication, when you start hearing about we're going to start thinking about how to get back to work, optimism will start increasing for the consumers that are home buyers and otherwise. I think people will just, who have not lost their jobs, who are continuing to work through this process, and if they were in fact sellers and or buyers prior to it but didn't get a chance to transact, I think we'll start seeing some of those folks show back up. And maybe that's what's happened in the last week or so, as we've seen business pick up. Certainly the demand, if not contracts on an absolute basis, demand starting to pick up. This whole event we talked about, there's kind of three things that have been in my mind. They're clear at this stage. This could change, and of course we'll use the program to continue to update you. But the three things that really have kind of jumped out to me in our industry that impact you and your customers. First, forbearance. By the way, forbearance is not forgiveness. Forbearance is a simple agreement to not require payments. And so that's what the stimulus plan requires of servicers throughout our country, is that they give government-backed loan customers the opportunity to either take a 3-month, 6-month, or 12-month sabbatical, if you will, making payments, but it does not reduce their need to make those payments. At some point down the road, they will need to make those payments either on a single balloon basis or on some kind of worked out deal over time. And by the way, the advice that we would give, that you should give to any of your customers, is they need to talk to the servicer who's handling their transaction. They are underneath the regulatory auspices of the federal government. They're required for purposes. They are required to, in fact, allow for forbearance. And then they're also allowed to negotiate exactly what those terms look like. So to the extent that that has been a big deal. And the reason it's been a big deal is because the servicers, as I've shared with you, are required, even if a borrower does not pay the payment, they've got to advance the money on to those that actually bought the securities. The reality of it is that has made servicers very concerned, which has reduced the demand for servicing, and more importantly, has reduced the demand for risk of any type in loans that we would do. And so the consequences of forbearance have been that jumbo marketplace has been pretty substantially dislocated. Does that mean I had a very, very talented realtor send me a communication late last week and ask if the jumbo market's still open? The answer is yes, but there are far fewer investors that are active in the jumbo market, and there are far fewer investors that are buying loans in the jumbo market, and loan to values have been reduced, meaning you have to put more money down in a lot of cases, and FICO scores have been increased. So there's clearly a tightening that's taking place in the jumbo market. If you have a buyer, it's under contract today, not yet closed, you need to be concerned with who is actually handling the financing at this point, because this is a very fluid topic as we speak. That is the jumbo marketplace. Again, I don't want to bring too much negative energy to it, because there still is availability. It's been reduced. Now, the good news is this: last year, the jumbo marketplace would have been about 5% of all of the financing in our country. For any realtor, however, that's on the phone who's listed a property or is representing a buyer who either needs a jumbo loan or the seller needs the buyer to have a jumbo loan, of course, there are some questions and concerns. So I would just be particularly focused if I was a realtor today and checking in not only with whoever's handling the transaction, but also then checking in with Supreme to get any opinion from us as to what you're hearing, if you're concerned at all. And we could talk about SRS here in a few minutes. The biggest thing that is concerning to our industry that comes off of forbearance as a consequence of not only forbearance, but also of just the general change in economic circumstances, i.e. 22 million people being unemployed in 4 weeks, is FICO scores have been on the increase. Two substantial banks in America, Wells Fargo, and today we understand that Bank of America both moved on their conventional loan programs to 700 credit scores. And then they've also reduced their loan to values. So they're not offering 95% financing now on their conventional loans. Wells is offering 80%, and we believe Bank of America is offering 90%. So they've reduced how much money they're willing to lend, and then they've increased the credit score at the same time. And it's a pretty big deal because the under 700 credit score buyer in America represents about 25% of all the homes that we financed last year. So when you think about taking a bite out of the housing market, that would be kind of a big deal if we lost 25% because FICO scores are higher. Now, in truth, some of these lenders continue to tell you that on government loans, they'll allow credit scores as low as 620 or 640. But if they've moved their conventional up to 700, I would tell you that it's probably going to be impossible with those big banks to get a government loan approved if it doesn't have a credit score over 700. So that's been a big consequence. If we wind up getting a resolution with the forbearance through the regulatory arms, as I've talked about in the past, I would imagine that's going to happen. Last week, we reported several articles, bipartisan communications from the Senate and the House have gone to now Steve Mnuchin, who is the Treasury Secretary of the United States, to ask him to support the loan servicing business and the mortgage industry so that we don't continue to tighten up credit at a time. He doesn't want credit to get tight right now. You don't want it to get tight. I don't want it to get tight. We actually don't need that to happen, right? So truth is, hopefully we'll get some relief on that, and we'll keep you informed to the extent that we get updated. What drives housing? Let's stop just for a second because I think it's important for all of you that you think about from your industry standpoint, what really drives our industry? Well, there's three things that are the most prominent fundamental drivers to determine whether or not housing will be healthy. And this is an historical idea. First is demographics. It's simple. People either rent a roof or they own a roof. 67% of Americans on average over the last 30 years have owned a roof. So the numbers are pretty stable with regard to those that own roofs in America. So as we grow demographics, and we are growing demographics, of course, more demand for roofs, either to rent or to own, takes place. And here's a quick look at exactly that point, right? Since 2010, we've increased in America the number of people by 20 million. So what's happening is we're increasing the demand for roofs to either rent them or to own them. And since homeownership stays at a relatively consistent level around 66 to 67%, as we increase demographics, then we increase demand for roofs. And that's a good thing, especially if you're in the South, because there is certainly, and has been for years and years and years, evidence of movement of demographics from the north part of America to the southern part of the United States. So we're seeing more and more people move into the South, into Florida, of course, Georgia and the Carolinas, and it all benefits us from a housing standpoint. One of the second things that drives housing is interest rates, the cost of money. And we are still today, folks, currently at a rate that is the lowest in our generation. It's actually the lowest in history on 30-year fixed rate mortgages. We're hovering around 3.5% as we speak. We have the Federal Reserve behind us telling us that they are going to buy more mortgage bonds so that they can continue to keep rates at where they are, or they will drive rates lower. We expect that to happen, but that's the second big issue. So we have demographics, they are favorable today. We have interest rates, they are favorable today. And then what finally drives housing is the idea of employment. And of course, we've already talked ad nauseum about employment. It's my belief at this stage that because this event happened the way it did, shut the lights off. As we talk about reopening, optimism will start, businesses will get back to work, and we'll see a not only flattening of the curve from an unemployment standpoint, but we'll see the other side of the cycle where we'll start to see a pretty substantial improvement of employment. So we're tracking unemployment today. We won't know until the end of the first or the end Friday, the first week of May. The unemployment number will come out in our country. Expectations are it'll be somewhere around 13 or 14%. Keep in mind, that's going from May to, March to May. We would have gone from 3.5% unemployment to a number that's almost 14%. And again, we've not seen employment numbers that high since the Great Depression. So I don't expect they'll stay there. That's the good news. We got there in a hurry, and I think we'll get out of there in a hurry. So those are the three fundamental things that drive housing. So let's take a look at what Fannie Mae, they just updated their forecast. Our good friend who's been involved with Supreme for some time, Doug Duncan, who's the chief economist with Fannie Mae, he just recently put out his forecast. I want to draw your attention to, and by the way, all these slides are available. So to the extent that any of you want these slides, just tap on the shoulder of your Supreme LO, loan officer, and we'll get these slides for you. All the way on the right-hand side, up at the top of the screen, annualized sales in housing last year, the housing industry moved about 6 million units. So of the demographics in America, there's 330 million Americans, and 160, 170 million of them are adults. They have households. About 6 million people acted last year to buy a home. That was a 1% increase from the previous year, 2018. We went into the year expecting that the 6 million was going to go up by about almost 3%. So it would have been about 6.3 million. The new estimate now is that this year's housing sales will be down to 5.139. That's a 14% decrease from the rate of sales in 2019. Altogether, to be honest with you, if that forecast came true, I'll take it, because we've seen in the last month or two closer to a 35% decline. So a good portion of the decline of 14% is kind of tucked in to our current market conditions. So we're already in the middle of writing that story, if you will. So I would argue maybe the worst of it is over. We're going to hope it's going to turn out that way. Good news is hope for the future. 2021, there's an increase projected by Fannie Mae of 14% off of 2020. So that's pretty important to note, because that means that all the work that you do today and tomorrow with your customers will be in an industry that looks like it will be getting better over the next 6 quarters. The third quarter of this year and the fourth quarter of this year, both will be better than the second quarter. And then each quarter next year is forecasted to get better. In the center of the page, still at the top, I want to move to the top, Ty, right in the middle, right there. Perfect. So 6.3 million sales in annualized, that would have been the rate. That was the first quarter of 2020. So we had a great first quarter. If you look just to your left, in 2019, our first quarter in housing sales, which is not the biggest quarter in housing sales, first quarter in 2020 was better than all of 2019, any of the quarters, right? So housing obviously is better in the spring, summer than it is in the winter. And so we got out of the gate amazing this year. Market was on fire hot. And of course, now we're in the middle of coronavirus with the lights turned off in the economy. And you see how we go from an annual pace in the first quarter through March of 6.3 million sales, down to what is going to be the low for some time, just under 4.2 million sales in the second quarter. But then we go to 4.6 million annualized in the third quarter, and finally 5.3. So if you track with me, we're in the middle of the worst quarter, second quarter, and we expect that the third quarter will increase some 15% from our current pace. And then the fourth quarter will increase another 15% from the third quarter's pace. So hang in there, because it'll maybe start getting a little bit of light, and maybe it's not going to be bright shining light right away. But my sense is that when we get into June and July, market conditions will be better than they are today, which is always good hope, right, for the future, that things are going to get better. And then next year promises to be a pretty strong year overall in comparison to what we'll experience this year. So at the bottom of the page, I wanted to bring your attention to another pretty important point, because we made the point that demographics, employment, and interest rates drive housing. Fannie Mae's forecast on interest rates, first quarter, by the way, they were around 3.5%. Their forecast for this quarter is more like 3.3. We're not quite there yet, but they're expecting we're going to get there. And then look at where we go from there. We go 3.1 and 3% in the third and fourth quarter, and actually get down into the high twos as we get into 2021. So the blessing is that if you think about our business, and there's three things that drive it: demographics, those are favorable, and they're getting more favorable for us that live in the South. We have interest rates at generational lows, historical lows, and they are forecasted to get better. And then we have unemployment, which, by the way, was completely attributed to us intentionally turning off the lights of the American economy so we could get coronavirus's curve to flatten. We did that. And now we have the unemployment problem that we have, but we expect that it's going to get better. In terms of recovery, here's the way I think about it. I want to share it with you. Shorter is better. Listen, just 6 weeks ago, we were in the best employment market ever as a nation. The economy was really doing well. So the idea that we can start going back to work, even if it's not a full, complete, go back to our normal way of life, but some recovering more than we currently have, shorter is better, because people will snap back into believing still sentimentally that things were really good, so they'll get better. That optimism, that hope is really important. The longer we stay shut down, the more cost and the more damage psychologically I think we're going to be doing, because every week, of course, more people get unemployment, and every week people get a little bit more cabin fever. You're seeing it on TV right now. So I think that cabin fever, by the way, will work as a benefit as soon as we start opening back up. Spring weather getting to be good, even though we missed the Masters this year, is going to help. And I think just optimism in general for getting back to some degree of normalcy, I think will help our business. And again, my numbers that I'm looking at Supreme, and we think statistically we're big enough. We do about 6,000 mortgages a year, so we do an awful lot of mortgages. Statistically, we're tracking with the Fannie Mae numbers right now. So feels like they're on the dime right now, and they're a very good forecasting organization, and it feels like they're on the dime. I mentioned jumbo loans and I mentioned FICO scores. I want to make sure that all of you know that I bring those to bear, those points, not to have you be concerned or afraid, not to talk negatively about any of our competition. We don't do that. I want you to be familiar and aware, because you cannot afford, in a marketplace that has fewer transactions, we can't either. We can't afford to miss a single transaction. We have to essentially execute better than we ever have. You do, we do, to make sure that every potential buyer and seller, we get them landed where they want to go, so that we yield the most out of this marketplace as possible, right? So our service tells you a story. Our SAT rates are extraordinarily high, just under 99%. Our close on time rate, which is critical, that means you get paid on time. And right now, everybody needs to get paid on time, is over 99%. And of course, we market speed, because we've built our systems at Supreme Southeast so that if you want to go fast, The fastest you can go in our industry is 8 days, and we can take you from start to finish in 8 days. Tell your customers that, because we'd love to help you if you have an opportunity to get something under contract that needs to get done. Or if you have a problem someplace else with a lender, which is entirely more likely now than it was when we started the year, because this forbearance issue is affecting every lender differently, and so is the refinance business. So the truth is that I want you all to know that. Back up one slide, if you would, Ty. On the issue of FICO, I want you to know that we, in being sensitive to watching the FICO score targets go higher, and as I shared earlier, 25% of the business is under 700. We are building a program. It will be introduced this Friday for the first time. It will run every single Friday subsequent for your customers. And that is so that your customers can participate in a free, let me say it again, free, it's free program where they will get advice from Lisa Myers, who is one of the top people in America in terms of mortgage credit. She'll be working in general terms on Fridays to talk to customers about what you should do to improve your credit score and what you shouldn't do. And let me tell you, if you're a realtor out there today and you got a pre-approval and you got somebody out driving around in the car, you need to ask them what their credit score is, because if it's 625, they're no longer eligible. If it's 640, it may go to 660 coming up here soon. You want to get them in Credit Essentials with us on Friday, because most people can get 25 to 50 points increased in their credit score if they simply work at doing it. So if they're under 700 today, and they're out looking for a home, they can get one, but they could get caught in the cycle of credit score change, and then they'd have to work backwards to get things done. We'd rather get them proactively in a system where we're improving their credit scores. So if you got a customer today, check in on them. When you refer to us going forward, if we get a customer that's at 630, 640, 650, we're going to be putting them in Credit Essentials, 30 minutes. It's all it takes. And then they can, we can give them kind of an individual pathway to improve their credit scores, so that we take the chance to make sure that we have a potential buyer and make sure that there's no way they get off track, that they ultimately wind up buying, because we want to make sure that you maximize this year. That's what our effort is all about. So that's what's up with Credit Essentials. Supreme Rescue Service, which is a program that we've marketed. Hopefully you all are familiar with it. And in the real estate community, the rescue service itself that we provide is really simply if you have an issue, get us an opportunity to get a second look at it or a second opinion. So if you have a transaction that's stuck someplace or is a problem someplace, let us take a look. We'll get it to our essentially emergency unit who does triage on loans, and they will work through as to whether or not there's a pathway we see to get things done. If the answer is yes, we can generally go very, very quickly and bring a transaction to conclusion. As I said, in 8 days in a lot of cases, we can get done that quickly. So the long and the short of it is, today, as we close up News You Can Use, we're working to get Doug Duncan. Hopefully we'll have him on live next week with Fannie Mae. I've been back and forth with him. He's obviously been a little bit busy. He had to rebuild his forecast this year in a pretty radical way. But we started out the program today talking about it's a lot easier to tell your story than it is to live it. We're all living it right now. So I just want to tell you all, I'll pray for every single one of you. If not individually, I'll pray for all the folks that are affiliated with our organization, for that matter. For all of Americans, I will. And I want you to do everything you possibly can right now to get better at what you do, both personally and professionally. So if you've misbehaved at the house with your significant other and or spouse, tell them you're sorry. That way, if this continues for another month or so, it'll wind up being, well, let's just say manageable. So it's at that time now. I really do think we're getting closer to the dawn, if you will. So we'll get out of the darkness that's been this incredible event. And again, as I've shared with you, we really need to pay close attention to getting the economy back open so the unemployment numbers kind of flatten. We need the curve to flatten at this point. If that happens, and we start getting back to work into May and into June, I think we'll see the housing market pick back up, and we'll have a better second half of the year than we're having a second quarter for sure. And then certainly there's reason for hope and optimism as we get into 2021. That's it for today. If we have any questions, you can register them now.
All right, Pat, we everybody who's on here on the Zoom call, if you use the raise your hand feature, we will take you off of mute so you can ask your question. And we do have a question that came in from Facebook. And just to clarify, can anybody attend Lisa Meyer's credit class? Can realtors make referrals to their customers? Are they able to attend, and how will they find out about that?
That's a great question. You do not have to be a customer of Supreme, but we would prefer you to be a customer of Supreme. We're offering the program via Zoom, just like we're doing today. It'll be a 30-minute program. They can register through our loan officers, of course, but you can go to Supreme Best as well, and we'll allow registration to take place there. The point of the program is to take potential home buyers or people that you're currently out showing right now who had a fine credit score a month ago, 2 months ago, 3 months ago, and then coronavirus came and credit scores requirements have gone up. They may not even know their credit score is below where it needs to be. So that program will be there. It'll give them generic information about how to think about improving their credit score. And then if you're connected to Supreme, you can actually individualize a plan with Lisa Myers through a Supreme Lending Loan Officer, and therefore we'll give the customer back a very specific plan for how they can get their credit score to go higher so that they can stay not only as a home buying prospect, but that they can ultimately wind up being one of the 67% of Americans who own a roof as opposed to rent a roof.
Okay. We actually do have a question coming in from someone, a guest here named Q. Did I get you unmuted all right? You can go ahead and ask your question. Well, there it is. Let me see. Q, you're unmuted here. Can you ask your question? I think you have, there you go.
Can you hear me now?
We got you. We can't see you, but we can hear you. So go ahead with your question.
Awesome. So I just want to make sure that I understand clearly. For any FHA loan is now a 660 and conventionals are now a 700?
No, so that's a really good question, Q. So it depends on lenders. FHA technically has not changed their credit scoring. Lenders are the ones that establish what loans they're willing to buy and what they're not willing to buy. Mm-hmm. Most lenders now are at 640 with their FHA credit score.
And
there are some, we're at 640 on our FHA credit scores. Mm-hmm. So last year we did probably 2% of our loans below 640. So it's not a big number, but we don't want to lose any home buyers. So if somebody was at 625 or 630, we're pretty confident if they go to Credit Essentials Q that and they follow through, and you help us encourage them to follow through, that they can get from 625 up to 640. So if 640 is kind of the minimum today, we're concerned that absent forbearance get resolved anytime soon through some of the liquidity ideas that we've talked about, that we could see the industry move up to 660, in which case you may have some customers that are currently out active and feel comfortable that they're going to be approved, and yet maybe they're not going to be because they're not aware that the credit scores have gone higher. So we've set up this program exactly to support the volatility in credit scores, where the data is telling us that they're going higher, and to make sure that those folks who want to buy homes can absolutely get themselves in a position to buy homes.
Thank you.
You're so welcome. Thank you for being here today, by the way.
Of course.
All right. I don't see any more hands going up. So Pat, why don't you say your final goodbye, and we'll land this plane.
I just want to encourage all of you. I do. We try to act as a voice of inspiration and education in the community and the marketplace. I don't try to, however, encourage people or inspire people falsely. I think we're all in a great struggle and been in a great struggle for some time, but there's a tremendous amount that we all have to be grateful for, even in the struggle. And I'm reminded of that every day. I'm also reminded that adversity either gets accepted by us or it gets rejected, where we just get angry and we complain and we don't do anything about it. You know, I'm taking the approach, and I'm challenging every single person that's a part of Supreme, that let this adversity that we did not create ourselves, but let it encourage us to get better, do everything we possibly can do to get better as people and to get better as professionals. So I just ask you to carry that message. Hopefully you're getting some data out of News You Can Use that can help you with your customers. You can welcome to bring your customers or let them get access to News You Can Use. Welcome to invite them to next Monday's program. And you're welcome to invite any that need help in terms of their FICO score to go to Credit Essentials starting this Friday. With that, I'll look forward to chatting with you all next week. Have a great afternoon.
Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
All right. Well, if everybody is good here, we are going to end this program. It is archived on Facebook. So it takes a few minutes. It'll be archived there on Facebook Live. And we will make these slides available to all the Supreme Lending Loan Officers. So if you are our guest on here today, you can reach out to them and they can make it available to you. And if you do not know a Supreme Lending Loan Officer, don't know how you found out about it, but we're glad you're here. But put a comment on the Facebook page and we'll connect with you through Messenger and make sure that you have access to the slides. So thank you everybody for joining us today for another News You Can Use. And we will see you as long as we need to, which hopefully won't be that much longer. Hopefully we'll get to a point where we don't need to do this show in perpetuity. That's why we called it the road to recovery. So when it's done, we can all get back to what we'd rather be doing, which is celebrating a thriving economy rather than trying to figure out how we get back to it. So we'll see you all later. Thanks so much for joining us today.